In the last 2 years corporations have poured sums that once seemed impossible into artificial intelligence. Stock charts that used to move in quiet slopes now look like cliff faces. Investors repeat the same promise in every interview and every earnings call. This time will be different. This time the machines will pay for themselves. But there is a quieter line item hiding behind the headlines. The math. When we walk through the numbers, the story bends in a different direction. Money is going out fast. Money is not coming back at the same speed. Revenues exist, but they do not match the scale of the build. This is not the first time a new technology captured the imagination. A pattern repeats across generations. A breakthrough arrives. Leaders declare that every industry will be reborn. Capital floods in. Share prices leap. Reality eventually shows up with a clipboard and a bill. The technology works. But not at the scale and not at the margin that the pitch decks promised. Companies that spent too much have no way to earn it back. Prices fall. Projects get shelved. Value evaporates. We have seen this cycle with railroads in the 1800s. With radio in the 1920s. With the dot-com wave around 2000. With digital coins after 2021. Now artificial intelligence stands in the same bright light with the same shadows at its feet. The claim is not that the tools are fake. They are very real. They write text and code. They analyze images. They search and summarize. They can feel like magic the first time you use them. The claim is that expectations have outrun the cash flows that would need to justify the spend. Costs are high. Use cases that people will pay a premium for are narrow. The business model is still being invented while the bill for hardware and power arrives every month. Start with the scale of spending because the scale defines everything that follows. In 2023, global outlays on artificial intelligence facilities and gear were in the neighborhood of $200 billion. That covers data centers, graphics processors, networking, power delivery, cooling. All the physical pieces that make model training and model usage possible. In 2024 that figure jumped again toward $350 billion. Early plans for 2025 push the number higher still. Add those together and you approach $1 trillion on infrastructure over 3 years. That total does not include research budgets. It does not include salaries for scarce engineers. It does not include the price of buying startups for talent or patents. It is the hard cost of the metal and the electrons. Who receives those dollars? The suppliers of the engines that drive the training runs. Chip makers sell graphics processors at prices that used to be reserved for small servers. Corporate buyers order them by the pallet. One training cluster can cross $500 million before the first line of code is executed. Major platforms are building not one cluster but several in parallel across regions. Every site needs land, steel, concrete, transformers, backup generation, thousands of racks, miles of fiber, lake-size cooling loops. Cloud giants have become the landlords and the power companies for this new factory model. One firm publicly tied tens of billions of dollars to new capacity and to a strategic partnership with a leading research lab. Another firm reported a similar figure while racing to develop its own custom accelerators to reduce dependence on outside suppliers. Others followed with spending plans in the tens of billions of dollars across 2 years. Add in the second-tier data center operators and large enterprise buyers and the total climbs still higher. The obvious question is what comes back on the other side of the ledger. If $300 billion goes out in 2 years, what is returning as revenue that can be traced to artificial intelligence products rather than to legacy lines? Here the numbers shift from bright to gray. Consumer subscriptions exist. Enterprise licenses exist. Usage-based fees exist. But after tallying them we do not arrive anywhere close to the level of spending. Consider the most visible independent research outfit. Annualized revenue climbed into the low single-digit billions by late 2024. That is impressive growth from a small base. Yet reports indicate that the cost of the computing time required to serve customers likely exceeds the top line. If the price of every answer is measured in cents and the volume of answers is measured in billions per month, the bill for electricity and rented processors can swallow the subscription income. In that scenario, the faster you grow, the more cash you burn. On the platform side, the story is mixed. One software titan embedded assistants into Office suites, into developer tools, into the search bar. Some of that revenue can be counted. But the company does not split the figures with surgical precision. Independent estimates put the direct contribution from artificial intelligence-specific products in the $10 to $15 billion range on an annual basis. Against aggregate infrastructure outlays that run in the tens of billions of dollars, that payback period stretches across many years before profit enters the picture. And that assumes stable cost curves and steady adoption. Another search and advertising leader invested heavily in its own chips while also buying from suppliers. It is providing artificial intelligence features across consumer products at very low prices or at no price to defend market share. Giving away a costly service helps retention. It does not immediately help margins. In cloud divisions, artificial intelligence services are growing but remain a subset of the total. The result is that break-even sits several years out under optimistic scenarios. A major social network used machine learning to sharpen targeting and to keep users engaged. Those improvements help the core advertising machine. But new assistants aimed at consumers remain mostly free. The revenue lift is blended into the overall ad engine, which makes the return on the latest wave of spending hard to isolate. A retail and cloud conglomerate sells artificial intelligence tools inside its infrastructure business. There is real money there already. Yet even with that head start, the sums are still modest when set against the new capital plan. Voice assistants running in the home have not proven to be profitable over a decade, which suggests that simply adding more capabilities does not transform the economics. Add the pieces. Across the largest buyers, the combined incremental revenue that can be clearly linked to new artificial intelligence products likely sits far below the combined capital outlay in the same period. Some analysts peg new product revenue in the low tens of billions of dollars per year. That number will grow. It will not grow fast enough to close a gap measured in hundreds of billions of dollars unless pricing rises or costs fall by an order of magnitude. That is the heart of the thesis. A spending-to-revenue ratio that points to a multi-decade payback in an industry that reinvents itself every few years. In technology, a 20-year payback is a bet that the competitive field will freeze in place. It never does. Now widen the lens. Every model must be trained. Training requires vast amounts of energy. Every query must be served. Serving requires more energy. Orders for power connections are now measured in dozens of megawatts per site. Utility planners warn about timelines measured in years to add generation and transmission. Local communities ask hard questions about water for cooling and about land use. Costs that were once quietly buried in operating budgets now show up in public hearings and regulatory filings. This is not yet a crash. It is the preface to a stress test. If revenue growth does not bend sharply upward, if per-query costs do not fall sharply downward, if capital markets begin to demand profits instead of promises, then the curve that pointed straight up will start to flatten and then to turn. The pattern is old. The details are new. The math is unforgiving either way. Now we move from spending to the product reality. Consumers and companies will only pay at scale when the use case is clear, the time saved is obvious, and the bill fits inside a normal budget. So far, that triangle is hard to close. Most individual plans are priced between 10 and 30 per month. That sounds simple. But it forces a brutal math. To support a global build that reaches into the hundreds of billions, providers need hundreds of millions of steady paying users. The mainstream consumer market is not there. Curiosity trials convert to a smaller core of loyal users. Price increases risk churn. Cutting price helps growth but widens the loss on every query if costs do not fall even faster. Enterprise demand looks better on paper and slower in practice. Large firms want privacy, security, and control. They want answers that are correct inside their domain, not flashy outside it. That means integration, data pipelines, governance, and change management. Those are service projects. Service revenue scales step by step, not by the million at a time. Each rollout requires experts, training, and ongoing care. Margins compress while the clock keeps running on the hardware depreciation schedule. Look at productivity claims with cold eyes. Coding assistants can speed up boilerplate and help juniors avoid dead ends. Writers can outline faster and summarize more. Analysts can draft first passes. All of that is real. But organizations capture only a portion of time saved, and part of the time saved turns into more iterations rather than fewer headcount. The lift is meaningful. It is not the revolution that pays for a global factory of new data centers by itself. Underneath, the cost stack keeps pushing upward. Training a top-tier model requires massive clusters, weeks of runtime, and careful orchestration. That is a one-time cost for each major version, but major versions arrive in a steady drumbeat. Then comes inference, the meter that never stops. Every prompt is a small cost. Billions of prompts transform small into large. If an application handles 10 billion requests in a month and the average cost per answer sits in the low single-digit cents, the monthly bill presses into 9 figures. Annualize and the numbers force hard choices on pricing and on the size of free tiers. Yes, hardware improves. New generations of accelerators bring more throughput per watt. Yes, software improves. Compilers, kernels, quantization, caching, and routing shave cycles. But models also grow. Context windows expand. Multimodal features add heavy paths for audio and video. What you save on one side is eaten on the other. The net result is progress that is real yet not fast enough to flip the economics in a single leap. There is another constraint that does not care about press releases. Electricity. A single large site can draw tens of megawatts around the clock. Regions with spare capacity welcome the investment. Regions without it ask for patience while utilities add transmission and generation. Water for evaporative cooling becomes a local issue. Noise and heat become community issues. Permitting stretches timelines. Financing costs accrue while waiting for power. Now consider strategy risk. If you are a platform, you must offer artificial intelligence features to defend your base, even if the direct margin is thin. If you are a challenger, you must offer something bolder or cheaper to break in, which often means subsidizing usage. Both paths compress profit. Both paths keep the revenue to cost gap wide in the early years. Vendor risk is next. Heavy buyers worry about being trapped by a single chip supplier or a single cloud. They build or buy alternatives. Custom accelerators promise better total cost of ownership over time, but they require many cycles to mature, and they are not free to design, verify, and manufacture. Shifting a stack from one architecture to another creates short-term friction and a two-track tooling burden. During the transition, capacity must be purchased on both lanes. Geopolitical risk sits in the background and sometimes in the foreground. Manufacturing concentration in a handful of locations means that weather, earthquakes, or conflict can ripple through supply for quarters. Export controls change the reachable market and the product mix. Currency swings change the effective price of imported components. Insurance and security costs rise for facilities that now rank as national-scale assets. Accounting reality eventually catches up. The useful life of a cutting-edge accelerator is short compared to a conventional server. Next generations arrive quickly, and resale value of the old is not generous. Depreciation runs hot. If revenue per chip does not rise as fast as depreciation per chip, earnings sag even when top line looks strong. Investors will tolerate this as long as the promise of future margin holds. If that promise fades, they will demand a pivot from growth to profit. That is when spending slows and the suppliers feel the shock. There is also a strategic blind spot that bubbles create. Teams start to believe that the only path is the most expensive path. They default to the largest general models for tasks that a smaller fine-tuned model can handle at a fraction of the cost. They ship features because they can, not because the user will pay. They count daily active experiments as traction. They assume that scale is a moat when the true moat is a workflow that people adopt without being pushed. Now let us add a few signposts that tell us when the curve is bending. Watch the mix of free versus paid in consumer tools. If free tiers shrink and prices rise, the unit economics are under pressure. Watch enterprise pilots converting to multi-year contracts. If conversion rates stall, it means the proof of value was not compelling at operating scale. Watch capital expenditure guidance from the largest buyers. If growth slows from fast to moderate, it means the check writers are feeling the weight of amortization and power. Watch second-tier data center builders. If orders pause, that pause rolls downhill to component makers. This is not doom for the technology. It is discipline for the market. After the first wave, products must cross a simple line. They must either earn more than they cost, or they must point to a near-dated moment when they will. If they cannot clear that line, the subsidy ends. Investors have seen this movie. In the late 1990s, traffic and eyeballs were supposed to be enough. They were not. In the last digital coin surge, user wallets and token counts were supposed to be enough. They were not. In both cases, the underlying technologies did not die. They found sober uses and sober prices. The same end point likely awaits artificial intelligence. Ubiquitous. Useful. Priced like infrastructure rather than like gold. One more tension sits at the center of the story. Promise outpaces governance. Models can hallucinate. They can amplify bias that is present in training data. They can expose sensitive information if controls are weak. Regulators push for audits and for data provenance. Enterprises push for guarantees and for indemnification. Every layer of assurance adds cost. Every breach of trust adds friction. Without trust, adoption slows. With trust, costs rise. Either path keeps pressure on margins until the stack matures. So we return to the core question. Can revenue climb fast enough and can costs fall far enough to justify the largest build-out in recent tech history? It is possible. But possible is not the same as probable on the timelines that are currently priced into the market. That gap between possible and probable is where bubbles form. It is also where bubbles end. In the next part, we follow the money into the stock market and map how the unwind tends to proceed when expectations finally meet the ledger. The financial markets have always been mirrors of collective belief. In the last 2 years, that mirror has reflected an almost religious faith in artificial intelligence. Charts that once looked steady now rise in vertical strokes, and the companies at the center of this surge are spoken of as if they were building the next industrial age. But beneath the glow of those numbers lies the same tension that has undone every great boom before this one. Look first at the most visible symbol of the era, the chip maker whose name has become shorthand for the whole movement. Its stock climbed from roughly 150 to over 900 in less than 2 years. That climb created a market value above $3 trillion, a level that assumes not only endless demand but perfect execution and endless supply of cheap capital. At 65 times earnings, the market is paying $65 for each dollar of current profit. That ratio might make sense if artificial intelligence spending could rise forever. It cannot. Companies cannot spend $300 to $400 billion per year on infrastructure without showing return. The moment that return stalls, the spending stops, and when it stops, the revenue feeding the suppliers falls just as sharply as it rose. This is not speculation. Late 2024 already brought the first signs. Smaller labs that raised hundreds of millions in earlier rounds began to run out of cash. Compute bills came due. Investors who once cared only about growth now asked about profit. Some startups sold their teams to larger firms for less than half the amount they had raised. Others shut down quietly. It is the same pattern seen in every innovation bubble. The early stars turn into acquisition targets or case studies. The few that survive carry the industry forward, but the field around them burns clean. The parallel to the dot-com collapse is unavoidable. At the turn of the century the Nasdaq index hit 5,000. 2 years later it was near 1,100. 78% of the value was gone. The survivors, firms with revenue and cash flow, went on to dominate the digital world. The rest became history lessons. Artificial intelligence in 2025 looks like the internet in 1999. The technology is real. The valuations are built on assumptions that cannot all be true at once. Every investor says this time is different, but every chart eventually rhymes with the last. The unwind follows a rhythm. First comes disappointment. Growth slows, but the faithful call it a pause. Then comes realization. Earnings reports reveal that revenue from artificial intelligence lines is smaller than hoped. Then comes capitulation. Capital expenditure cuts begin. Suppliers feel the contraction. Stock prices adjust downward, fast. Nvidia will likely lead that move because its exposure is the purest. A 50 to 70% correction from the peak would erase $2 trillion in market value and still leave the company huge and healthy by historical standards. The larger platforms will follow with smaller but still heavy declines, 20 to 40%, as investors mark down the portion of their business tied to artificial intelligence infrastructure. Startups without real revenue will fall hardest. 9 out of 10 will fail. That is the usual ratio when hype meets cost. It sounds catastrophic, but in truth it is the process of normalization. After the collapse, what remains is the technology stripped of illusion. A few strong players reach profit. The tools settle into daily workflows. They become invisible infrastructure, as the internet became invisible, as databases became invisible. The value does not vanish, it redistributes. Instead of 10 trillion in paper wealth built on speculation, 2 trillion in steady value remains built on use. 8 trillion evaporates, but what is left endures. There are counterarguments, and they deserve mention. One is that artificial intelligence will find vast new revenue sources, transforming industries and creating trillions in efficiency. Another is that compute will become dramatically cheaper, restoring margins. A third is that general intelligence will arrive and make the debate obsolete. Each contains a kernel of truth. But history warns that timing is everything. The transformation always takes longer, and costs always decline slower than the first generation of believers predict. Even if general intelligence arrives, its economics are uncertain. If machines replace knowledge workers at scale, total wages fall. With less income, consumption shrinks. The economy contracts. It is the automation paradox. Technology that eliminates jobs can also eliminate the market for its own products. That is not a profit story, it is a social story that demands policy and adaptation. So what should investors do? This is not financial advice, only analysis drawn from the pattern that repeats across centuries. If you hold a position bought early and cheap, consider taking some profit. If you bought late at the top of the curve, measure your risk tolerance honestly. The correction will not wait for comfort. For diversified holders, expect compression, not destruction. Big technology firms will survive, but the era of effortless multiple expansion will end. For venture capital, treat every artificial intelligence startup as a lottery ticket. A few will win enormous prizes. Most will expire quietly. Never risk more than you can afford to lose. The rational strategy is to rebalance before the market forces you to. Take partial gains. Reduce exposure. Add assets that are not priced for perfection. When the decline comes, cash and patience will buy the survivors at fair prices. Do not try to guess the exact week or quarter of the turn. Bubbles deflate in stages, not in single moments. But they always deflate. Here is the likely path. In 2025 spending still rises, though slower. Investors start asking tougher questions on earnings calls. In 2026 reports show revenue shortfalls and large write-downs. Valuations adjust. By 2027 the contraction is public and sharp. Funding dries up. Startups fail. By 2028 the survivors emerge leaner, profitable, and integrated into the economy in a sustainable way. Artificial intelligence remains, but as plumbing rather than spectacle. 10 trillion invested. 60 to 80 billion in new revenue each year. The math has not changed. The technology is extraordinary. The expectations are impossible. When those two lines cross, the story resolves the same way it always has. Not with the end of innovation, but with the return of reality. And reality, as every market eventually learns, always wins.